Adobe Inc. ticker symbol ADBE is currently trading at $577 a share. What we're going to be doing today is looking at the stock and then taking it to my automated stock valuation spreadsheet to see if Adobe is a buy using discounted free cash flow model, the comparable company model, and the Ben Graham formula for intrinsic value. So as I said, this stock over the last year has been relatively flat from where it started from, but it's had highs of around about 630 and lows of around about 430. Over the last 5 years, you can see it is up almost 102% in that time, but has not reached its all-time highs of $660 a share. If we were to compare to the S&P over the last 5 years, you can see it does beat the market, up 102 compared to the S&P's 86. But over the more recent time frames, with it being relatively flat, the market has won. But is this the right time to buy? So what we'll do is we'll put the ticker in here, ADBE, and what this will do is it will load all the latest company financial data so we can have a deeper dive and to see if it is a buy or a sell. So just while everything else is loading, market cap of 250 billion, PE of just shy of 52, and with a market average of 29, that is quite a bit higher than the market average. Earnings per share of $11.14 and a beta of 1.3, which means it is slightly more volatile than the market. Analysts say it's priced at should be priced, at around about $550 a share. So maybe a slight sell, even a hold according to analysts. But let's have a deeper look. So we have sort of a breakdown of revenue here, but let's look at the annual revenue. This is going back from 2009, and in the trailing 12 months, they're at all-time highs, 20.43 billion, beating the previous year of 19.4 billion, and that has sort of consistently, they have been increasing their revenue every single year without fail, up 16% on the 5-year compound annual growth rate. Is income a similar story to revenue? Not really, I suppose. They have been able to generate quite a bit of profit in these last 5 years, but if we compare it to the revenue, the margins have decreased. In the trailing 12 months, 5.1 billion, down from its all-time high of 5.3 in 2023. Next, we'll look at free cash flow. Similar story to the profit, actually, 6.37 billion in the trailing 12 months, but still a 5-year compound annual growth rate of 13%. Shares, what are they doing with shares? Well, they're actually buying back shares, which is quite good for investors. If there's 10 shares of a company and you own one, you own 10% of the company. If they buy back if they buy back 5 of those shares, then you would then own 20% of that company because you would have a larger share of the profits. And they are buying back shares, which if we look over the last, let's see, 5 years, let's remove the S&P. We'll go on the 5 years. Yeah, with it being all over the place, I mean, realistically, when they were buying back shares from 21 to 22 and 22 to 23, they were pretty good investments there because the stock price did then rise after that fact. So overall, pretty good. Assets versus liabilities, pretty high. You can see the asset and liability switched in 2017, but it has been very, very consistent since then. So now let's have a look at the discounted free cash flow model. This is a way of valuing a company based on its expected future cash flows. With the averages, you can see it gives it a calculated stock price of around about $280 a share, which is obviously quite a massive discount at this point. Now let's have a look at these numbers and see if we agree. Revenue growth rate, we're estimating 8.2% based on the averages, 22.2 and 24 billion. Let's have a look at what analysts are saying in sort of the growth of revenue in that time. Yeah, 21.5 to 23 billion. The next 5 years are actually expecting quite high growth, around about 13%. So let's go on the bullish case here. Let's put that at 13%. Still $326 stock. Next, we look at the net income margins. As I said, net income margins were decreasing. There you can see it is here. So even on the bullish side, we'll keep it there. And let's take a average of the free cash flow to net income of the last few years. So that's 120%. I still think this is going to say it is an overvalued stock on discounted free cash flow. Yes, it is $378 per share. And with a free cash flow ratio of 37 and the average of the last 5 years of 51, that is no surprise that it doesn't like this stock. If we were to kind of increase this, say they were expanding about 16% a year, they were able to get those margins up to sort of 35%, and then 120%, yes, even then still see $500 stock, but does have room to grow. Next, we'll look at the comparable companies model. This is a way of valuing companies looking at similar companies in industries which are, and also similar sizes as well. Now, with Adobe, they don't seem to have any direct competitors in their space. Obviously, they're kind of the giants in that subscription model, graphical software space, but if we were to type in, for example, another one, Microsoft are quite similar, IBM, and even, let me have a look at Google, see what Google say. Comparable companies, would be nice if I could spell. Oracle really a competitor to them? Quite difficult to see here. I'll just, yeah, see IBM, Google. Okay, fine, we'll go with Oracle. Google, you give me the answers here. So what this will do is it'll actually load all the financial data for these similar stocks. We'll look at revenue growth rate, profit margins, price to sales, price to book, PEG, EV to revenue, EV to EBITDA, and PE. Revenue, obviously this is the smallest of the four companies. Enterprise value, second smallest only to IBM. Revenue growth rate similar to Microsoft. Actually, they are growing their revenue pretty highly at 16.5%. Microsoft's 14.36%. EBITDA a lot lower, and net income a lot lower as well. Profit margins, despite it decreasing, Microsoft is 36%, Adobe is 25%, beating out IBM and Oracle. PEG, which is Peter Lynch's formula, price to earnings growth, lower is better. Ideally you wanted them under 1, but it is the lowest out of these four companies. Now let's have a look at EV to revenue, EV to EBITDA, and PE ratio, where you can see here the implied share value is around about $407 a share when we take in the average of these, because you can see it is consistently the highest out of all of them. What I'll do actually, let's just take out, we'll switch Oracle and IBM just quickly, because I want to look at the comparisons without IBM and then without Oracle. But it is hard to do this because they don't really have a direct competitor. See, if we remove IBM from it and just looking at these companies more with their cloud aspects, still overvalued slightly, but $470 a share. Even if they were valued as in the same way that Microsoft are, still not a buy at $510 a share. So I'm quite surprised that actually I would have thought that with those sort of revenue growth rates and profit margins, it would have been more of a more lucrative in terms of this, or looking at the comparable company model. But interesting to see that it is not a buy. So that is the discounted free cash flow model. Say it's about $400 a share. Comparable company model also says about $400 a share. Now let's have a look at the Ben Graham formula for intrinsic value. And I think we said that this has around about 13.8, we'll do 14% growth, and that puts it at $200 a share. So obviously with the bond yield being as high as it is, if we bring that down to 4, 3, 2, well, we never have that. Yeah, even with a 2% bond yield, this would still be slightly overvalued. So interestingly, that Ben Graham likes it the least with a $200 share price. Comparable company puts it somewhere in that 400 to 500 range. And the discounted free cash flow model probably puts it at about 400 on the high side. So all the models are kind of in agreement that it's not a buy right now. Right, guys, thanks for watching. Please give a like on the video if you enjoy it. Check out my Patreon as well if you're interested in this automated stock valuation spreadsheet. And I'll catch you guys next time.